Look at this photo of the Federal Reserve Building. Today, traders spend thousands of hours dissecting every word that comes out of here, obsessing over macroeconomic data, interest rate policies, and external news flow. But compare that modern obsession to this image of a crowded, chaotic trading floor from decades ago. Long before algorithmic data feeds and instant global news, the core mechanics of making and losing fortunes were exactly the same. We routinely see highly intelligent people who have mastered chart patterns and moving averages still suffer sudden, catastrophic wipeouts that destroy weeks or months of hard work. The exact moment a portfolio dies rarely has anything to do with a poor entry price or a bad technical setup. The fatal blow happens at the precise second a trader chooses to ignore the evidence and refuses to admit they were wrong. Profitable speculation requires looking past the candles and the ticker tape. The real volatility lives inside the trader's own reactions, and survival depends on analyzing these internal traps with the same scrutiny applied to charts. Imagine you enter a position based on a solid, well-researched plan, but within minutes, the price action begins to slip against you. Look at this chart tracing an asset's price breaking downward through a 3% stop-loss line. This threshold objectively proves the trading hypothesis wrong. Notice the highlighted area above the break. Professionals view this tight drop as a simple business expense, a minor tuition fee. But the amateur reacts differently. Instead of cutting the cord, they hold the position. Executing the exit forces the ego to accept that the initial analysis was flawed, and their pride simply cannot handle the rejection. As the loss deepens past that initial threshold, a dangerous transition takes place. The trader stops looking at technical support levels entirely. They abandon their proven strategy and start relying on a single coping mechanism: hope. In a system defined by strict probabilities, hope is toxic. It marks the precise instant a person stops managing risk and starts blindly begging an indifferent market to validate their intellect. Once a trader enters the state of denial, they stop looking at the price action objectively. They begin hunting for external validation, desperately scrolling for positive news headlines or analyst upgrades to artificially justify holding their bad position. This desperation leads directly to the gambler's fallacy of averaging down. The stock sinks, and instead of taking the initial hit, the trader pours more capital into the losing position, convincing themselves that they only need a tiny bounce to break even. The math quickly becomes lethal. The market continues its downward slide, turning what should have been a manageable 5% lesson into an unbearable 20% deficit on a doubled allocation. The tragic irony is that this exact same psychological flaw destroys the upside too. When a trade actually goes green, the terrified ego snatches the profit immediately, paralyzed by the fear that the market will reverse and prove them foolish. The trader secures a tiny, fleeting win to satisfy their pride. By doing so, they sacrifice massive, life-changing gains, while simultaneously hoarding portfolio-killing losses. This demand for psychological validation breaks the basic arithmetic of trading success. You cannot achieve long-term profitability if your primary goal is to avoid the momentary discomfort of admitting a mistake. Look at this antique stock ticker machine surrounded by paper tape. It is a reminder that the market is a cold, merciless system. It does not know your name, it does not care about your analysis, and it communicates only through raw price reality. Think of a sour trait the way a retail manager looks at spoiled merchandise. You don't leave rotting fruit on the shelf demanding full price. You mark it down, take the hit, and clear the space for something that actually sells. Every financial loss needs to be stripped of its emotional weight. To a professional, a red number on a ledger represents a neutral data point, a standard variable in a long sequence of probabilities. The greatest skill you can develop is preserving your capital. This capital can only be protected through absolute emotional detachment from the outcome of any single trade. True profitability requires you to follow two mechanical rules, starting with the pre-commitment to cut losses ruthlessly. You must place your stop-loss before you enter the trade, executing the exit with the cold precision of a surgeon following strict protocol. The second rule is to let your winners run. You manage your downside risk strictly, but you allow the market itself to dictate the exit, giving the position the breathing room it needs to fulfill its full potential. We can see these exact behaviors repeating throughout history. Look at this photograph showing crowds gathering during the bank panic of 1907. The collective human reaction to risk, denial, and fear has remained entirely unchanged for over a century. This timeless blueprint of market psychology was documented by early operators, like the man in this portrait, legendary speculator Jesse Livermore. His experiences proved that human nature is the only true constant in finance. Ultimate survival demands that you kill your ego. You have to practice accepting failure every single morning, surrendering the expensive luxury of being right in exchange for the quiet discipline